This is Nightly Business Report with Bill Griffith and Sue Herrera.
Lifting the curtain, new details have emerged on why the Federal Reserve decided to make an about-face on policy and what it might do next. In pain, as CVS Health integrates its Big Aetna acquisition, an older takeover is giving the company a real headache. And living in fear of an audit, what are the odds that the IRS will actually come after you? Those stories and much more tonight on Nightly Business Report for this Wednesday, February the 20th. And we do bid you a good evening, everybody, and welcome. Sue is off again tonight. Back in January, when the Federal Reserve seemed to reverse its policy of increasing interest rates, the stock market cheered. But many investors still asked why. And today we seem to get some answers. In the minutes of the central bank's most recent meeting, policymakers cited a sharper than expected slowdown in global economic growth and the potential risks that posed to the American economy. And that's not all that they talked about. Steve Leisman starts us off tonight from Washington.
We learned in the minutes from the Federal Reserve's January meeting that almost all Fed members want to end the balance sheet reduction later this year. That's news to the market. We thought that the $4 trillion balance sheet would be reduced over a longer period, say well into next year. But the Fed said in its minutes it will announce a plan to halt that reduction, quote, before too long. And many in the market think that could happen as soon as March. The Fed noticed that the markets thought it was too inflexible on the balance sheet reduction, not really paying enough attention to changes in the economy. So the Fed adopted a patient and flexible policy approach to balance sheet reduction. And that led to a new statement that came out of the balance sheet at the January meeting. On the critical issue of interest rates, the Fed explained its pivot to a pause from gradual rate increases because it saw growth risks increasing. It noted that financial conditions had tightened with the big sell-off in the market. There was also the government shutdown and trade tensions, leading the Fed to expect slower growth in 2019 than it previously had. It also saw softer business and consumer sentiment, and the outlook for foreign growth also had turned weaker. At the same time, inflation was muted, so the Fed saw little risk in pausing. How long will that pause last? Well, some in the minute said that the Fed might return to hiking rates later this year, depending upon economic developments. And some thought that was not likely. We'll have to watch economic data and listen closely to Fed speak over the next couple months to know if a return to rate hikes is possible in 2019. For Nightly Business Report, I'm Steve Leisman in Washington.
Scott Brown joins us now to talk about those minutes and Fed policy overall. He's chief economist at Raymond James. Scott, thanks for joining us tonight.
My pleasure.
In those minutes, they also expressed surprise at the decline in the stock market in December, as it seemed that the market misunderstood their policy, that maybe they weren't as hawkish as the stock market seemed to think. Do you think the market has been wrong about Fed policy?
I think that you've certainly seen a very heightened level of sensitivity to even minor changes in the Fed outlook. Back in December, in his press conference after that policy meeting, Fed Chairman Powell said that the low inflation outlook would allow the Fed to be patient. Yeah. So they used the same language in June or in January. So really, I don't think it was a drastic change. The Fed's gone from sort of a mild tightening bias to essentially what is neutral. And the bottom line is that the future Fed policy decisions are going to be data dependent still.
Right. And there were some today, and there have been for the last few days on Wall Street who feel that the Fed is probably going to have to raise rates before the end of the year, maybe in the fall sometime. What do you think?
Well, the correct answer is always it depends. If the economy picks up, and we've certainly seen a lot of downside risks. You had the government shutdown, you have trade policy uncertainty. We saw a pretty sharp drop in both business and consumer expectations in January. A lot of those fears and downside risks may be starting to abate a little bit. And if the economy continues to gain strength, then yeah, it would be appropriate to maybe tap on the brakes a little, maybe a rate increase in June, maybe another one in December. But we're still a long way from that. The Fed has plenty of time. We're not seeing a lot of pressure from inflation.
And before you go quickly, if the Fed does start raising rates, what do you think the market does about that?
Well, it depends on why the Fed is raising rates. If it's because the economy is strong, I mean, you'd like to see continued growth in earnings. I don't think there's any real danger that the Fed is going to choke off growth here.
Yeah.
And I think that's still a positive outlook.
All right. Scott Brown, the chief economist of Raymond James, again, thanks for joining us tonight.
Thank you.
Meanwhile, on Wall Street, stocks meandered for a second consecutive day, although the major averages did get a small bump after the release of those Fed minutes. A rise in technology stocks helped the NASDAQ turn in its 8th straight day of gains. By the close, the industrial average was up just 63 points. We're to 25,954 now. The NASDAQ added 2, and the S&P tacked on just about 5 points. The other big issue for the market is still trade, and a resolution of the U.S.-China trade talks could be just the thing that drives equities higher. Bob Pisani takes a look now at where stocks may be heading.
The market is pretty clearly pricing in a trade deal. I guess the question is, how much exactly is priced in? Art Casher from UBS thinks it's at least 50% priced in, but it could be more. And with that comes potential risk to the recent rally. So if a trade deal is announced by that March 1st deadline, the uptick in stocks should be fairly modest if it's priced in. And the market seems comfortable knowing the deadline could be pushed back or delayed. But if the White House announces no trade deal and tariffs on China go to 25% from 10%, that's not priced in. Stocks could drop significantly, perhaps even back to their December lows. So with the S&P 500 hovering near 2,800, what could push it over 3,000? Besides a trade deal, talk of the Federal Reserve possibly easing would be significant, and any clear sign that the Fed would slow down the unwinding of its $4 trillion balance sheet. Also, less talk about an earnings recession. That would be a big help to the markets. I think, though, most importantly of all would be less talk about a global slowdown. Some positive growth in Europe, that would help. Some economic stability in China, that would help. And even better economic data out of the U.S. than we got last week with those dismal retail sales and disappointing industrial production numbers. Meanwhile, new highs are expanding. The market looks good. There's little reason to sell right now, and the Dow's on pace for a 9th week of gains. The problem is it's hard to argue that the market is really cheap right now, given how far it's advanced off of those December 24th lows. The bottom line is this: it's looking very hard to move the market forward, notably, unless you get stability on the global growth front and some kind of trade deal in the mix. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
We had mixed signals in the oil patch today. Oil prices did rise to their highest level of the year after Nigeria said it was willing to reduce its output. But the Energy Information Administration also is forecasting record shale production here in the U.S. of nearly 8.5 million barrels per day next month. But that did fail to slow oil's rise. Domestic crude did settle above $56 a barrel, posting its 6th straight day of gains. Time to take a look at some of today's upgrades and downgrades. Transocean was upgraded to overweight from underweight at Barclays today. The analyst there called the stock undervalued and said that Transocean could benefit from a transformed offshore industry. Price target now is $10, but despite that upgrade, shares fell a fraction to $8.69. Charles Schwab was downgraded to a sell from neutral at UBS. The analyst cited growth concerns and says that buybacks will not cushion the blow from rising costs. Price target now $42. That stock fell more than 1% today to $46.45. And Southwest Air was downgraded to a sell from neutral at Goldman Sachs, with the analyst saying that the airline's new route to and from Hawaii could be too costly. Separately, the airline cut its outlook for the first quarter, saying that revenue declines due to the recent government shutdown were bigger than previously expected. And the stock fell more than 5.5% today to $54.41. And the other airlines fell in sympathy on Southwest guidance, and that put a drag on the transportation sector today. So what is the Southwest airline downgrade and the weak guidance telling us about the state of the airline industry right now? Joining us tonight is Seth Kaplan. He's managing partner with Airline Weekly. Seth, good to see you. Thanks for joining us tonight.
Likewise, Bill. Good to be here.
Higher costs and maybe slower traffic due to the government shutdown. Is that sort of the perfect storm the airlines face right now?
Yeah, Southwest obviously has its own set of problems. No surprise that it led the sector lower, as you said. But, a few minutes ago, you were talking about those higher oil prices at their highs for the year. And, You can't talk about oil without also talking about airlines. Now, these airlines all think they're better structured than ever to deal with higher oil prices, but the immediate impact of higher oil prices is higher costs for airlines.
They don't have the pricing power to be able to raise prices commensurate with the rise in jet fuel?
Over to the medium and long term, they do, and really they do it through capacity moves. I mean, look, airlines are always charging as much as they think people are willing to pay at the moment. The way they get to higher fares is by constraining capacity. When they think oil prices are going up, they're going to start growing less. That's what they're doing a better job of these days than they did in the past. But there's lag time. The immediate impact is that if jet fuel costs more tomorrow than it does today, everybody tomorrow is going to be flying around on tickets that they bought months ago, schedules that were filed months ago, and that comes straight out of the airline's pockets.
Traditionally, airlines are very economically sensitive. Are they telling us something about the economy right now or not, do you think?
Well, right now the economy, as you know, is resilient, and the question becomes, well, what happens going forward? There have been patches of softness, Bill, where it could be a broader indicator. December had some moments of, what's going on with business travel? Generally speaking, more good than bad right now. The question becomes, what happens if the economy does turn down, and what does that mean for airlines? Obviously not good things, but more of a problem for airlines that depend a lot on premium traffic, the Deltas of the world. An airline like Southwest, maybe not as exposed to some of that.
All right, Seth Kaplan with Airline Weekly. Again, thanks for joining us tonight.
Thank you, Bill.
Still ahead, CVS's checkup, why an old acquisition could slow the health company's move in a new direction. CVS Health is now telling investors that 2019 could be a rocky year for the company. They issued a profit forecast that was well below Wall Street estimates, and that sent the stock down more than 8% in today's session. It also raised questions about its ability to integrate its recent acquisition of Aetna as quickly as it would like. Bertha Coombs has details for us.
This year, CVS Health is trying to focus on integrating its acquisition of health insurer Aetna and rolling out new services. But the problem is an old acquisition isn't working out as planned. CVS took a $2 billion charge for continuing losses in Omnicare, which it acquired in 2015. The pharmacy unit that caters to senior living and long-term care facilities had a major long-term care client file for bankruptcy in December.
The growth opportunity with Omnicare was always focused on the independent and assisted living spaces, and those opportunities, still exist. The challenges that we have in that business are really around the skilled nursing facilities, which, have been worse than we originally expected.
CVS's pharmacy benefits business is also facing pressure. The Trump administration wants to ban confidential rebates or discounts that CVS and other firms negotiate with drug makers, proposing that Medicare drug plans pass discounts directly to seniors at the pharmacy counter. CVS CEO Larry Merlo warns that the move will raise prices on Medicare drug plan premiums.
We see the rebate rule taking us backwards, not forwards. And, we've been very public about the fact that 100% of rebates are turned over, in the Medicare business and have been utilized to buy down premiums. You look at that dynamic, premiums will increase, and some actuarial reports have it, growing as much as 52%.
CVS says it expects to combat the issues weighing on its pharmacy units over the next year. It's a big challenge, as it's also facing higher costs to integrate its IT systems with those of Aetna. Total integration costs are expected to be $200 billion above the projected savings from so-called merger synergies this year. For Nightly Business Report, I'm Bertha Coombs.
So what next for CVS and for healthcare overall? Let's face it. Joining us tonight is Ross Muken. He's an equity analyst at Evercore ISI. Ross, thanks for joining us tonight.
Absolutely.
First on CVS, I mean, the Aetna acquisition was billed as the next step in the future of healthcare. Is that still the case, or is this a whole different story now?
Yeah, I think the entire time this was going to take quite a ways and quite a lot of investment to get to where they need to be to serve, the American people with a more integrated model for healthcare. But obviously, today the base was a little bit disappointing in terms of where we're jumping off from. But I think the premise and the industrial logic of why these businesses came together still holds.
But what I'm interested in is just around the time that this acquisition was announced, there was a scramble among other healthcare providers and insurance companies to get together. And none of that ever happened. The Anthem Cigna deal fell apart. Humana ended up only partnering with Walmart to try and reduce costs, but there's been no other blockbuster merger. What happened?
Yeah, I think, look, in the healthcare complex, large-scale mergers are always challenging and they're hard to agree to. And, understanding how the landscape's going to change, particularly given all the political noise, is not particularly easy. But I think, these assets made a lot of sense together. What they're aiming to do eventually with the boxes or the stores and with the Aetna member base all should eventually lead to lower costs for people. It's just the path there is going to take more time. But, these are pretty complex deals and these are very large businesses. And so putting them together in a dynamic environment is certainly not easy.
So CVS says this will be a challenging year for the company. What do you think of the stock?
We still recommend it. I think the stock is quite inexpensive. Look, the entire time we thought it would take multiple years to kind of get to a place where you could start, for them, seeing them lower Aetna's, medical costs, which essentially should be passed on also to individuals, which should help them gain share. And so that's the whole premise here. Unfortunately, the starting point or the base for earnings is going to be lower than many of us expected. And so, we're jumping off of a lower point, but I still think, the ability to sort of, revolutionize parts of healthcare still holds.
Maybe we just need to be patient. It is a big deal. Ross Mukin with Evercore ISI. Thanks again for joining us tonight.
Thank you.
Constellation Brands is slimming down, and that's where we begin tonight's market focus. The spirits company said today it is looking to sell some of its lower-end wine brands so that it can focus on the more profitable high-end market. Constellation expects its earnings to take a hit from its investment in Canadian marijuana company Canopy Growth, which reported a loss last week. The stock of Constellation fell more than 4% today to $166.98. And speaking of marijuana, Canadian marijuana company Tilray plans to buy Manitoba Harvest. That's the world's largest hemp food maker for more than $300 million. Tilray's CEO sees the deal as an opportunity to speed up its entry into the United States.
They have relationships with 30,000 acres of hemp grown by farmers. They have a state-of-the-art processing facility where they make these products. And then they have a distribution channel through 13,000 the largest retailers in the U.S. And our intent is to use that supply chain to help accelerate the CBD products that we will introduce by this summer.
Tilray shares rose more than 5% today to 81.10. Tesla's top lawyer is leaving after just 2 months on that job. The electric car maker's general counsel, who represented CEO Elon Musk last year when he was sued by the SEC, has now decided to return to his old law firm. It is the latest in a string of high-level departures at Tesla. Shares were down 1% today to 302.56. Healthcare company Magellan is considering selling itself after coming under pressure from activist hedge fund Starboard Value. Magellan is reportedly in the early stages of exploring such a deal. Shares rose nearly 11.5% on that news to 72.45. And Gannett missed earnings and revenue estimates despite a spike in digital subscriptions. The newspaper publisher has been hit by layoffs and declines in print revenue. The results come as Gannett faces an unsolicited takeover bid from hedge fund-owned MNG Enterprises. Gannett shares dropped more than 5.5% today to $10.63. And late today, Disney and Nestle said they were pulling their ads from YouTube after reports of a pedophile network showing up in the comments section of certain videos. YouTube has come under fire before from advertisers who do not want to show their brands represented next to offensive or extremist content. Well, your cable bill is likely a big monthly expense, but ditching cable and cutting the cord is not necessarily a simple process, in part because of all the options available, which can seem overwhelming, of course. And in the end, consumers just want to know if it's worth it. Julia Borston digs into that for us tonight.
Welcome to the bundle. Consumers are increasingly creating their own streaming bundles from 3 major types of services: First, there are the sports apps, such as ESPN Plus, boxing app DAZN, and WWE Network. Second, there are ad-free premium content apps, such as HBO and Showtime, along with Netflix. And third, skinny live TV bundles from Hulu, YouTube, DirecTV, and Sling.
There's both a plus side for the consumer in terms of the increased choice, but there's the other side of that coin, which is that choice creates dilemma. It creates difficulties. You have to make decisions.
So is it worth it to cut the cord? To compare traditional TV with the new options, we created 2 sample digital bundles. Take a look at what a sports lover might pick. Along with high-speed broadband, DirecTV is a good live TV option for sports fans because you can access NFL Sunday Ticket. If you add boxing service DAZN, ESPN Plus, and Netflix, this bundle would cost $138, down from the $215 a cable bundle can cost in Los Angeles. But if you don't care about sports and are more interested in premium cable content, you might bundle your broadband access with Hulu for live TV because of its originals. Add in HBO, Showtime, and Netflix, that would add up to approximately $154. Digital bundles can end up costing more, depending on the discounts you get on your cable bundle and how many streaming apps you choose. Broadband costs generally increase when you call to cancel cable. But for people who don't want to pay, there are a range of companies betting on the ad-supported market, which generated $28 billion in revenue last year, according to eMarketer.
There's no question that there is a real market for ad-supported streaming video, insofar that there are an enormous number of advertisers that really want to be able to get exposure and make connections with consumers who are using those services.
NBC Universal is creating an ad-supported streaming service for pay TV subscribers. Facebook is licensing more professional content for its Watch video hub, and Viacom bought ad-supported Pluto TV. These are among a range of ad-supported services, including the Roku channel, Tubi TV, Xumo, Sony's Crackle, Freedive, owned by Amazon, and Walmart's Vudu. And we'll see how Disney and Apple's upcoming subscription options change the landscape. With all of these choices available, whether it's worth it really depends on what you want. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And coming up, tax audits. They're time-consuming, costly, and stressful. But what are the odds that the IRS actually audits your returns? Samsung has unveiled a new line of Galaxy phones, and they fold. The company hopes that the Galaxy Fold will help turn sales and provide the innovative kick that the smartphone industry is looking for. Samsung spent 5 years developing its foldable technology, which comes with a price tag of nearly $2,000. Meanwhile, Hershey is adding its name to the list of companies raising their prices. Remember, yesterday we told you about everyday items that are likely to see a bump in prices this year. And today, Hershey said that it plans to put a new pricing structure in place in North America in 2019. The company says it will use the extra revenue to maintain its strong investment in the business and to help offset rising operational costs. Well, it's tax time, and there's one thing that all filers have in common. It's concern that they will be audited. But the answer to that might be different this year. Robert Frank explains.
As many taxpayers are discovering, the new tax code is filled with loopholes and gray areas, but their chances of getting caught by the IRS are the lowest in 15 years. The IRS audit rate has fallen by half since 2011. Only 6 in every 1,000 returns were audited in 2017. The IRS did 630,000 fewer audits last year than they did in 2011. The wealthy, which are audited the most, have seen the biggest reduction. Among those making $1 million or more, about 1 in 6 used to get audited. Now it's less than 1 in 20. The main reason, many say, is budget cuts. The agency's total budget is down 16% since 2011. Its staff has been cut by 24,000, and the number of auditors, known as revenue agents, has fallen from about 14,000 to under 10,000. That is the lowest number since 1953.
You have this perfect storm of these budget cuts followed by this very complex law, and now you have honest taxpayers in the first filing season of this law trying to file their taxes, And if they have a question, which they have many questions, they call the IRS, they can't get the phone answered. They just passed the most complex law, right? The Congress passed that. It's a Congress responsibility to give the IRS the right resources to implement it.
Many Republicans say it's a bloated bureaucracy that became politicized under the Obama administration and should be reformed and cut even further. Now, while some in Congress are seeking to increase funding for the agency, especially to improve its outdated technology systems, others say the agency itself could be made obsolete if we just made the tax code a little simpler.
If we had a simple, neutral, fair system like a flat tax, a lot of these problems would disappear because you wouldn't need these big fights between rich taxpayers and the government because the system could be simple if politicians would let it be.
But for now, it looks like the biggest rewrite of the tax code in more than 30 years will be administered by an agency short on cash. For Nightly Business Report, I'm Robert Frank.
And finally tonight, Fast Company is out with its list of the most innovative companies in the world. At number 1 is a Chinese tech platform that expedites booking and delivery services like food, hotel stays, and movie tickets. Number 2 is an app called Grab. It's a Singapore-based ride-hailing company that expanded into other services. And rounding out number 3 is the NBA. The magazine cited its move into esports, and it has seen growth in its streaming service as well. Before we go, a final look at the day on Wall Street. Kind of a quiet day again with the Dow up 63 points. The NASDAQ added just 2. The S&P added 5. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching. See you tomorrow.